Hi all, this is Ashish Kyal here. Welcome again to Elliott Wave News channel by Wave Strategy Advisors, and it's pleasure to speak to all of you. And based on a few requests which I have received over past few days, I would be covering probably one of the most simplest technique that should be used anyone who is probably into trading or even for investing. This is a one very basic and important technique which I follow very closely, and I think it's one of the most important aspect of technical analysis is that even when you do advanced concepts of Elliott wave, neo wave, or time cycles, you need to still adopt some basic strategy like the bar technique, which we are going to discuss today in today's session over a short stint. The reason of preponing this interview from Friday to Thursday is because tomorrow I'll be speaking at a conference in Pune at National Institute of Bank Management, and so I'll not be available. So I thought it's better to prepone it and rather than missing it out. To start with, quickly start with it. The first thing to note is Nifty has been moving in absolute sideways action. On the upside, if you remember, in last week we discussed about the level of 846061, which was very important to be crossed and closed for the positive trend to resume. And on the other side, on the downside, Nifty has been managing to protect somewhere around 8370 levels on the closing basis. So we have been moving in a range, and there has been a stock specific movement which has been happening during this range bound action. So if even if one has to trade, it has to be stock specific. At the same time, one shouldn't expect too much of a trend in the stocks unless there is a clear breakout on the Nifty. The reason I say this is that in case you are long on the stocks and Nifty give a downside breakout, the chances of stocks moving higher drastically reduces. So even when stocks have their own independent characteristics and own independent property, those stocks will start moving sideways even if they want to move higher. But because of the major index falling, these stocks will start moving sideways and will not be able to provide you the required outcome. Similarly, it is therefore very much necessary for you to understand the direction of Nifty even when you are trading an individual stock. So to do that, I think Nifty has to either close above 8460 for the positive trend to resume, or it has to break down below 8370. That's the first level I've been talking about, which will decide that the short-term trend is actually probably reversing. So that these two levels are very important. Keep a watch on these two levels, and the momentum of movement from here on is going to be important for deciding what is the maturity of the trend. We still live by the time cycles which are still in the selling pressure, so selling mode. So as per time cycle, we still have a few more days left until the cycle bottoms out. So unless and until the cycle bottoms out and we start seeing the green shoot, I think it is time to stay alert, it is time to stay cautious, and keep a watch on the crucial levels. So let's now quick start with the concept of bar technique that is the main heading for today. Let me share across my screen for Nifty. Okay, this is the chart of Nifty, daily chart of Nifty. Now, one very important aspect over here that I observe very closely is the bar technique. Now, this bar technique is one of the most objective way. The reason being, you do not do any kind of forecast. At the same time, you are completely objective. You know when to enter or when to exit. So over here, if you look at the price movement from the lows of somewhere around 7,900 when Nifty formed in late December, from there itself, it has been I think almost 18 days now since Nifty has been moving higher, and not a single time, if you look at these bars, not a single time prices have closed below the prior day's low. I'll again repeat, not a single time prices have closed below the prior day's low. So over here, if you check, there has been never a close which has been below the prior day's low. So the close is not there below prior day's low over here. Now, at this point of time on 9th of January, prices did move lower. However, it still managed to close above the low. The low which was made was somewhere around 8233 and price closed at 8236. So if you look at it, I mean, it's not just coincidence. That's how market works. It gives due respect to the prior day's low. And not a single time in this entire sideways range over past 6 days, I suppose, Nifty has been constantly protecting the prior day's low on the closing basis. So this the entire trend. So if you follow one such simple technique, you will see that during a trending move, the closing becomes very important, and this closing invariably protects the prior day's low. This is one of the most important and the basic technique we explain when we do our trading seminars for 2 days. This is one of the most basic techniques that I explain. Over here, during the downtrend, if you look at it, prices will invariably protect the high of the prior day. So in this entire downtrend from this point to this point, if you look, there has been not a single close above the high of prior day. And this movement was again substantial from the levels of 8274 to 7900 levels. So not a single close in this entire down move has been above the prior day's high. This was the first bar when markets closed above the prior day's high. So that was the indication that probably the downtrend is getting over, or we are expecting some sideways action, some kind of a consolidation pattern. So always remember, so if tomorrow we see a close below the prior bar's low, always remember either markets are going to move down or it's going to consolidate. It does not mean that it's going to go down sharply, because bar technique is not telling you to how the markets are going to react. It's just telling you what you have to do based on the closing basis of the bar. So that is one of the most objective technique that one has to combine along with other concepts of Elliott wave, Neo wave, because Elliott wave and Neo wave will help you forecast and will help you understand the maturity of the trend. Whereas bar technique will help you with the concept of bar technique will help you with when to enter probably and when to exit. So even if we expect that the market should move lower, but unless and until the reactive method, so this is a reactive method, and Neo wave is about predictive method. So unless and until your reactive method also confirms that by breaking below the important lows or the pivot lows, you shouldn't be entering into the trade. Now, once you enter into the trade, then you start forecasting in order to understand till where the specific price movement can be and how the strength of the down move is going to be. So for those things, time cycles and Neo wave will help. That is how the entire concepts of reactive and predictive methods are combined together. So in a nutshell, look at the bars, probably on a daily, not also daily. If you go and check the hourly chart, let me open an hourly chart. And this was during a trending move classically. During a non-trending move, it becomes a little difficult. But during a trending move, even on the hourly scale, prices will not close below the prior hour's bar. So if you check here, there is not a single close in this hourly chart which is prior bar's low. So prices have been managing to protect the prior bar's low on the closing basis. This is an hourly chart. So you can apply this concept on the hourly chart, you apply it on the daily chart, you can apply it on the monthly or weekly chart. So if you are an intraday trader, you apply it on a 30-minute chart and try to use it. If you are probably a swing trader, apply it on the daily chart. If you are an investor, apply it on the monthly chart, and you will see how amazingly well it has worked. So you can apply this concept on different time frames, and it will work because markets are fractal. So fractal nature is something which defines that it will work from the smallest of the degree to the biggest of the degree. So I will not be able to cover much more on the fractals and where this technique will fail and other things. But this is something that food for thought is. You start building up on a very basic technique, and trust me, it works. So start building up, keep your stop losses in place, keep your money management strategy in place, and use one of the basic techniques and combine it with other different techniques that you have, and you will see a drastic improvement. So I think this covers what I wanted to convey across, and I'll be again speaking same time next week. And it is always pleasure to be here. Keep sending across your questions so that we can accordingly address it in this session, and accordingly I can talk about any specific requirement. So I can always do that. Also, before closing out, just one more announcement is we are conducting a training in March on 18th and 19th of March, which is a weekend in Mumbai, on which will be covering this bar technique definitely, and how we are combining these various basic techniques like bar technique, moving averages, indicators, oscillators together, along with the advanced concepts of Elliott wave, Neo wave, time cycles, and channels, which are again very, very important. So how we are combining each and every technique together in order to produce a very, very high probable outcome and that will help you to capture the swings in the markets, whether it be in intraday or probably positional trades, or even for investments, how to create those investment portfolios. So we'll be covering those things in the upcoming training in March. For more details, you can always reach out to us on 9920422202, or you can drop a mail on helpdesk@walesstrategy.com, or visit the website walesstrategy.com. That's it from my side. Ashish Kyal here, and thank you very much for your time. Appreciate. Have a wonderful week ahead.